Welcome to another edition of YaleNats Financials. Today we're going to be talking about Treasury bills, Treasury notes, Treasury bonds, and how they are used. There are three debt securities for investors like me and you. They vary by the maturity rate, which is how long you'll need to have them, and by the interest rate. But first, don't forget to hit that like button. These bills, notes, and bonds are backed by the U.S. government. It's paid by the U.S. government, so it's considered one of the safest investments out there. But that means it brings back some of the lowest returns. Treasury bonds, sometimes referred to as long bonds, mature after 30 years of holding them. After you purchase them, you will receive interest payments every 6 months. They often pay some of the highest interest rates since you have to hold them for so long. If you are interested in buying these, you can pick these up at online government auctions. These are very popular bonds that people use to save money for things such as retirement and college funds. Treasury notes are kind of just like Treasury bonds, but they're shorter, anywhere from 1 to 10 years. They sell in $100 increments and also pay out 2 times a year. As with Treasury bonds, Treasury notes have 2 types of way you can bid on them at auction. You can do competitive bidding or non-competitive bidding. Competitive bidding means you basically specify what interest rate you want to pay. Now with this method, you may fill your order, get your order partially filled, or end up leaving with no bonds at all. With non-competitive bidding, you basically get your Treasury notes at the market price. Treasury bills have shorter maturity than Treasury notes and Treasury bonds. Treasury bill maturities are usually 1 year or less, meaning that the yield for the Treasury bills will be a lot lower than the notes and the bonds. Unlike the other two, these are sold in $1,000 increments. So you loan the government money so they can build schools, roads, and fund their other projects. Unlike its big brothers, the Treasury bill does not pay interest. You actually buy it at a discount. For example, if you bought a $1,000 Treasury bill today with the interest rate at 2.431%, you would pay $975.90 for it. And after it matured, you would get the $1,000 covering your yield. The government pays you interest to borrow your money, and the interest is considered the yield. And the length of the Treasury bill, the Treasury note, or the Treasury bond is considered maturity. This is also known as a debt security. These are the 2 factors that will create the yield curve. Ideally, the longer you hold a debt security, the higher the yield will be. So if you see news segments about panic coming from inverted yield curves, now you know what this means. The government wants to pay you more money to hold your money longer. But the market demand and investor confidence can make yield rates grow and shrink. Are any of you guys debt security holders? If so, drop down in the comments and let us know what you started with. Until next time.